Welcome to Thoughts on the Market. I'm Mike Wilson, Morgan Stanley CIO and Chief U.S. Equity Strategist. Along with my colleagues bringing you a variety of perspectives, today I'll be talking about the labor market's impact on equity markets. It's Monday, September 9th at 11:30 a.m. in New York. So let's get after it. Last week, I wrote a detailed note discussing the importance of the labor data for equity markets. Importantly, I pointed out that since the materially weaker than expected July labor report, the S&P 500 has bounced more than other macro markets like rates, currencies, and commodities. In the absence of a reacceleration in the labor data, we concluded the S&P 500 was trading out of sync with the fundamentals. Over the past week, we received several labor market data points, which were weaker than expected. First, the job openings data for July was softer than expected, coming in at 7.7 million versus the consensus expectation of 8.1 million. In addition, June's initial result was revised lower by 274,000. This essentially supported the view that the weak payrolls data in July may, in fact, not be related to weather or other temporary issues. Second, the job openings rate fell to 4.6%, which is very close to the 4.5% level Fed Governor Waller has cited as a threshold below which the unemployment rate could rise much faster. Third, the Fed's Beige Book came out last week. It indicated that activity remains sluggish, with 9 of the 12 Federal Reserve districts reporting flat or declining activity in August, though commentary on labor markets was more neutral rather than negative. These data sync nicely with the Conference Board's Employment Trends Index, which I find to be a very objective aggregate measure of the labor market's direction. This morning, we received the latest release for the August Conference Board labor market trends, and the trend remains down, but not necessarily recessionary. Of course, the main event last week was Friday's monthly jobs and unemployment reports, where the payroll survey number came in below consensus at 142,000. In addition, last month's result was revised lower from 114,000 to 89,000. Meanwhile, the unemployment rate fell by only a couple of basis points, leaving investors unconvinced that July's labor weakness was overstated. Given much of these labor and other growth data have continued to skew to the downside, the macro markets like rates, currencies, and commodities have been trading with more concern about potential hard landing risks. Perhaps nowhere is this more obvious than with 2-year U.S. Treasuries. As of Friday, the spread between 2-year Treasury yields and the Fed funds rate matched the widest levels in the past 40 years. This pricing suggests the bond market believes the Fed is behind the curve from an easing standpoint. On Friday, the equity market started to get in sync with this view and question whether a 25 basis point cut in September would be adequate policy response to the labor data. In the context of an equity market that is still quite rich and based on well above average earnings growth assumptions, the correction on Friday seems quite appropriate. In my view, until the bond market starts to believe the Fed is no longer behind the curve, labor data reverses course and improves materially, or additional policy stimulus is introduced, it will be difficult for equity markets to trade with a more risk-on tone. This means valuations are likely to remain challenged for the overall index, while the leadership remains more defensive and in line with our sector and stock recommendations. We see 2 ways in which the Fed can get ahead of the curve: either faster cutting than expected, which is unlikely in the absence of recessionary data, or the labor market starts to improve in a convincing manner and 2-year yields rise. Given the Fed is in the blackout period until next week's FOMC meeting, and there are not any major labor data reports due for almost a month, volatility will likely remain elevated and valuations under pressure overall. This all brings our previously discussed fair value range for the S&P 500 of 5,000 to 5,400 back into view. Thanks for listening. If you enjoy the podcast, leave us a review wherever you listen and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.